Hello and welcome back to the channel. If you're joining us for the first time, please consider hitting that subscribe button and ring the bell icon. This way, you'll stay updated with our daily insights designed to help you navigate the world of finance. Banks often give us the misleading impression that our money grows through the simple accrual of interest. However, the reality is that the increased balance often fails to keep pace with inflation, leading to a gradual but significant erosion of wealth. As inflation continues to rise and bank interest rates lag, merely storing cash in bank accounts becomes less effective. In this video, we will explore 7 key assets that can help safeguard and increase your wealth, ensuring that your financial legacy can thrive and be passed down through generations. Asset 1: Precious metals. Gold, silver, and other precious metals have traditionally played a pivotal role in wealth preservation, acting as reliable safeguards against inflation and economic fluctuations. These assets are particularly valued for their ability to maintain purchasing power, even when traditional fiat currencies falter under economic stress. Their intrinsic worth stems from their scarcity and universal acceptance as forms of currency and stores of value, transcending geographic and political boundaries. For generations, families have invested in precious metals to secure their financial legacy, leveraging these assets' tendency to appreciate during periods of high inflation or market volatility. This characteristic makes them indispensable in a well-rounded investment portfolio, providing a counterbalance to more volatile assets. Moreover, precious metals can be passed down through generations with relative ease, maintaining their value over decades. By including these timeless assets in your wealth strategy, you not only protect your current financial standing, but also ensure that your prosperity can be shared with future generations, thereby fostering a lasting legacy of stability and security. As of now, without specific economic models or access to current market data and trends, it's difficult to provide a precise figure for 2025. However, if we consider the historical growth and recent increase in economic uncertainty, it wouldn't be surprising to see gold prices well above their current levels by 2025, potentially ranging between $2,000 to $2,500 per ounce or higher, depending on global economic conditions. For the most accurate and up-to-date information, it's advisable to consult financial forecasts and analyses close to your time of interest. By 2035, gold prices could be influenced by several factors, including global economic stability. If the global economy faces turmoil, recessions, or high inflation, gold prices are likely to increase as investors seek safe haven assets. Technological advancements, improvements in mining technology, or the discovery of new gold reserves could potentially reduce costs and affect prices. Monetary policies. Central banks around the world adjusting interest rates or engaging in quantitative easing could influence gold prices. Investing in gold, silver, and other precious metals can be an effective strategy for hedging against inflation and providing financial security during economic uncertainty. Here are some practical ways to invest in these valuable assets. 1. Physical metals, bullion coins or bars. You can purchase gold and silver coins or bars from reputable dealers. Coins like the American Eagle, Canadian Maple Leaf, and South African Krugerrand are popular among investors. Jewelry. While not the most cost-effective way due to markups for craftsmanship, investing in high-quality gold or silver jewelry can also be a way to hold physical metals. 2. Exchange-traded funds. Gold and silver ETFs. These funds hold physical gold and silver and are traded on stock exchanges. Examples include Spider Gold Shares, GLD for gold and iShares, Silver Trust, SLV for silver. These provide liquidity and ease of trading without the need to store physical metals. 3. Mining stocks. Companies. Invest in stocks of companies involved in the mining of gold and silver. These can offer leverage to the price of the metals themselves, often amplifying the gains and losses based on the underlying metal prices. Mutual funds and ETFs. Invest in mutual funds or ETFs that focus on mining companies, like the VanEck Vectors Gold Miners ETF, GDX. 4. Futures and options. Futures contracts. These are agreements to buy or sell gold at a future date at a predetermined price. They can be used for hedging and are traded on commodities exchanges. Options on futures. These give you the right, but not the obligation, to buy or sell futures contracts at specific prices before the options expire, providing a complex but high-leverage investment option. 5. Certificates. Gold certificates. Offer a way to own gold without physically holding it. These are issued by companies that possess gold, allowing investors to own the metal without the costs and hassles of storage. 6. Digital gold, gold-backed cryptocurrencies. Newer to the market, these digital tokens are backed by physical gold, stored in secure vaults, and can be traded on various cryptocurrency exchanges. Asset 2, stocks, mutual funds, and ETFs. Investing in a diversified portfolio of stocks from various sectors can offer substantial returns through dividends and price appreciation. Diversified holdings across various assets can reduce risk and enhance returns, managed by professional. Investing in a diversified portfolio of stocks, mutual funds, and ETFs presents a powerful strategy for wealth accumulation and protection, ensuring your financial legacy flourishes across generations. By allocating investments across various sectors, you significantly enhance the potential for substantial returns through dividends and capital appreciation. Stocks offer direct ownership in companies, providing the dual benefit of dividend income and the opportunity for substantial price appreciation as the company grows. Mutual funds and ETFs further fortify this approach by pooling resources to invest in a broad array of assets, thus spreading risk and tapping into a wider range of opportunities than might be feasible for an individual investor. This diversification is crucial in mitigating risks associated with market volatility and sector-specific downturns. Additionally, the professional management of these funds ensures that expert decisions guide the portfolio, adapting to economic shifts and capitalizing on emerging trends. Such a strategy not only aims to grow wealth in the short term, but also secures long-term financial health, making it possible to pass down a robust financial legacy to future generations. Through disciplined investing and the strategic allocation of assets, individuals can create a durable financial foundation that supports both current and future family members. Investing in stocks, mutual funds, and ETFs can be an excellent way to build a diversified portfolio that capitalizes on both dividends and capital appreciation. Here's a step-by-step guide to getting started. 1. Define your investment goals. Start by determining your financial goals, risk tolerance, and investment horizon. Are you investing for retirement, to buy a house, or perhaps for your children's education? Your goals will shape your investment strategy. 2. Open a brokerage account. Choose a reputable brokerage with reasonable fees and robust investment options. Many brokerages offer online platforms that make it easy to trade stocks, mutual funds, and ETFs. 3. Educate yourself on different asset classes: stocks, direct equity investments in individual companies, suitable for those willing to undertake research and accept higher volatility. Mutual funds. pooled investments managed by professionals that invest in a variety of assets. Great for those who prefer a hands-off approach. ETFs function like mutual funds but are traded on stock exchanges like individual stocks. They often have lower fees than mutual funds and provide instant diversification. 4. Diversify your portfolio. Invest across various sectors such as technology, healthcare, finance, and consumer goods to spread risk. Diversification can be achieved within asset classes, different stocks, or across asset classes, stocks, bonds, real estate ETFs. 5. Consider dollar cost averaging. Invest a fixed amount at regular intervals, for example, monthly, regardless of the share price. This strategy can reduce the impact of volatility by spreading the purchase price over time. 6. Monitor and rebalance. Regularly review your portfolio to ensure it aligns with your investment goals and risk tolerance. Rebalance as necessary by reallocating investments or adjusting your strategy based on performance and economic conditions. 7. Plan for taxes. Be aware of the tax implications of your investments, especially for dividends and capital gains. Consider consulting a tax advisor to optimize your tax liability. Asset 3. Bonds. Fixed income securities, such as bonds, are a cornerstone of a strategic investment approach aimed at wealth preservation and growth, providing a foundation for a secure financial legacy. These securities are particularly valued for their lower risk profile and the steady income stream they provide, making them an essential part of a balanced investment portfolio. By generating regular interest payments, fixed income securities offer investors a predictable source of income, which can be particularly valuable during times of market volatility or economic downturn. This reliability is crucial for those who are nearing retirement or need consistent cash flow to meet ongoing expenses. Additionally, the principal amount of these investments is typically returned at maturity, adding a layer of security for the capital invested. Including fixed income securities in your portfolio helps mitigate the higher risks associated with other investment types, such as stocks, ensuring that your overall portfolio remains more stable in fluctuating markets. This stability is instrumental in not just maintaining, but also methodically increasing your wealth over time, thereby securing your financial legacy for future generations. By carefully allocating a portion of your assets to fixed income securities, you can safeguard your investment while still pursuing growth through more aggressive investments, ensuring a well-rounded and resilient financial strategy that can support your family for generations to come. Investing in fixed income securities is a prudent way to achieve portfolio stability and secure a steady stream of income. Here are some common methods and examples of how to invest in these types of securities. 1. Government bonds, U.S. Treasury bonds. These are considered one of the safest investments since they are backed by the full faith and credit of the U.S. government. They come in various maturities, from a few years to 30 years. Municipal bonds, issued by states, cities, or counties. These bonds often offer tax-free interest income, making them attractive to investors in higher tax brackets. 2. Corporate bonds, investment-grade bonds. These are issued by corporations with higher credit ratings and are seen as safer than those issued by companies with lower credit ratings. High-yield bonds, also known as junk bonds. These offer higher interest rates due to the higher risk associated with companies that have lower credit quality. 3. Certificate of deposits, CDs. Offered by banks, CDs are time deposits with a fixed interest rate and maturity date. They are insured by the FDIC, making them very low risk. 4. Fixed income mutual funds, or ETFs. Bond funds. These funds invest in a variety of bonds, allowing for diversification within the fixed income asset class. They can focus on government bonds, corporate bonds, municipal bonds, or a mixture of all. Income funds. These funds focus on securities that produce a regular income. They typically invest in a mix of bonds and dividend-paying stocks. 5. Savings bonds, U.S. savings bonds. Such as Series EE and Series 1 bonds, these are non-marketable securities issued by the U.S. government that are a popular gift to children as they are secure and grow over time. 6. Preferred stocks. Although they are technically stocks, preferreds have bond-like characteristics, including fixed dividends and higher claims on assets than common stocks. Asset 4. Insurance policies. Life and other insurance policies play a pivotal role in wealth protection and ensuring financial stability for heirs, especially in the face of unforeseen circumstances. These insurance products serve as a foundational element of a sound financial plan, safeguarding your family's economic future and your hard-earned legacy. Life insurance, for instance, provides beneficiaries with a tax-free lump sum upon the policyholder's death, offering immediate financial relief and stability during difficult times. This payout can be used to settle debts, cover living expenses, or maintain the family's standard of living, thereby preventing the rapid erosion of wealth that can occur when primary income sources are disrupted. Similarly, other types of insurance, such as disability or long-term care insurance, protect against potential income loss due to serious illness or disability, ensuring that savings are preserved for future generations rather than being depleted by unforeseen health issues. Moreover, sophisticated estate planning can incorporate these insurance policies to facilitate the smooth transfer of assets, reduce estate taxes, and manage other liabilities that might otherwise burden the next generation. By using insurance strategically, individuals can not only protect, but also potentially increase their wealth through efficient tax planning and asset management techniques. Investing in life and other insurance policies can provide crucial financial protection and stability for your family and heirs. To understand better about insurance and how to best use it, watch our video now, Several Types of Insurance Policies, and how they can be used effectively in wealth protection and estate planning. See you there.